Now, for Indian investors who are seeking stability in their portfolios, it is bonds that are emerging as an increasingly attractive asset class. With the recent volatility in equity markets, portfolio diversification via bonds is also gaining prominence. Bonds usually provide a stable set of return, anywhere between 8 to 12 to 14 odd percent with limited risk. It also helps investors to diversify their portfolio from market risk to credit risk as well. In India, what we've been observing is that the bond market, which was previously largely limited only to institutional investors, it's not the case today. We are seeing growing accessibility of bonds through the new age platforms, minimum investment amount, which has really reduced the ticket size, and that is leading to a whole lot of investors now looking at bonds as an asset class that they should be looking for a core investment portfolio as well. To help us understand more about the bond market in India, what are the factors driving it, and whether this is the right time for you to really look at bonds as a diversification in your own investment portfolio, let me welcome on board. We have a very special guest joining in. Mr. Vishal Goenka, the co-founder of IndiaBonds.com, is now joining in. Warm welcome to you, Mr. Goenka, and thank you so much for joining in. I want to first begin by understanding, are Indians and retail investors finally warming up to the bond market?
No, absolutely, Sakshi. Firstly, thank you for inviting me to your show. Your introduction was amazing. Absolutely. There are two things that have changed, right? Firstly, 2 to 3 years ago, people did not have access or did not know where to go to invest in bonds. Thankfully, to SEBI regulated online bond platforms, now people have that access. Secondly, we saw a roaring equity market last 2 years into 2023 and 24, which has seen a bit of a wobble. And people are absolutely in the mindset to preserve the wealth creation that has happened, to kind of protect their capital and diversify their portfolio. So yes, they are waking up. Just to give you an idea, a number of transactions on the RFQ or the OBP platform in one of the exchanges has more than doubled in the last 1 year. From Jan to March on our platform, we saw 75% jump in volumes and number of trades, and it just kind of coincided with the wobble in the equity market. So yes. People who have made some money, have made some wealth, are waking up, is the right word, and accelerating towards bond investments.
Okay, so now Mr. Goenka, help us understand, those that have not yet looked at bonds at all as a part of their core investment portfolio, who exactly must ideally look to invest in bonds? What is the right kind of retail investor that you believe should definitely look at bonds?
So the short answer is everyone, and I will elaborate on that. When we talk about asset allocation and portfolio, globally in the developed markets, everyone talks about equity and fixed income to be the large chunks of that, right? So we have the 60-40 rule, 60 in equity, 40 in fixed income, or maybe 50 in equity, 30 in fixed income and alternatives. So depending on where you are in your life cycle, your savings, the allocation to fixed income can change, right? So let's say when you're in your 20s and you're trying to build a savings and investment portfolio, and large part could be in equities, but 20% is the minimum allocation everyone from 25 to even 75 should do. What we see is when people start making more or creating more wealth, the allocation to fixed income actually increases. So hypothetically, if you have 100 rupees, you might bet everything in equity trying to, get a rapid return. But when we start making 10 lakhs or 50 lakhs or 1 or 50 crores, you do not want to risk on a higher volatile assets and you want to conserve. So really everyone should be looking at it. People for life goals, it's a great way to save for an education, for a marriage, or in 3 years to 4 years time, if you want to save money and make 10 to 12% returns as you go though.
Okay, a 10 to 12% return over the next 4 or 5 years, if that kind of a horizon is what you have, then definitely bonds is something that you could be looking at. Now tell us, sir, what are the factors that are currently creating more buzz around bonds at this point in time? Why is everybody interested in talking about bonds at this current stage, sir?
So I will take it back that, people have seen an equity wobble because we're largely equity as an investment country. And I believe some of the small caps and mid caps have gone down by 40 to 50 to 60%. But importantly, you have to remember what is the interest rate cycle we are in. What do I mean by that? Central banks all over the world, and RBI included, hike or reduce rates in a 2 to 5 year cycle. For example, our rates benchmark repo rate was at 6.5% from February 23 for 2 years till 2025. And we are seeing RBI cut rates down to 6%. A lot of observers say they are front loading the infusion of liquidity. And I think this cycle would continue for another couple of years, barring any exogenous shocks. So this is a good timing perspective because if you invest in bonds, the interest rate cycle is in your favor. Not only in India, the recent data from US, where you had a 0.3%, minus 0.3% GDP, which means there was a contraction in GDP. You see the inflation data, and US does lead the direction. The magnitude of rates could be different. And we do anticipate that US would see some rate cutting happening, and then emerging markets like India would follow suit. So the timing from a macro perspective is perfect. You want to invest in an asset class which could give you capital gains. So equity, volatility, people are getting more aware and educated, right? Thanks to platforms, the dissemination of information due to technology is really helping people understand. It's their money. People can self-learn now, right? So hence, equity factors, interest rate cycle, global factors are helping people to move towards bonds and look at it again.
Okay. Now, I think a lot of people will also have this question in mind that when there are other debt options available with me, why should I choose bonds? So what is the USP? What is the added on factor that one should look at bonds vis-a-vis the other debt instruments, sir?
No, so the other so-called debt instruments, or the traditional debt instruments, and I'll name a few, is what people are used to.
Yeah.
Most of these debt instruments, whether through pensions or RBI floating rate notes or anything else, have one big disadvantage. They have huge lock-in periods. You cannot get out of that 5 to 7 year or 10 years because
Correct.
traditionally they've been only maybe made for senior citizens who have a very long-term view on that, right? Second problem they have, they are non-transferable, which means even if you want to get out after 5 years of lock-in, there is no way to sell it to somebody else. So hence, investing in corporate bonds, government securities is great because there is zero lock-in. You can buy it today, you can theoretically sell in 2 days' time. And you can transfer it, right? So sometimes people want to transfer to their children and things like that. Gift, you can actually give these transactions or bonds, to your family members. That's why they're so much better. Obviously, it's subject to market liquidity. People should invest depending on their own risk appetite. But these are tradable instruments and they are much better. The second biggest traditional instrument is fixed deposits. The whole country has been doing fixed deposits because our parents and grandparents told us that was
Yes.
the avenue they had to save money and earn something from it, right? Because your bank current accounts give you like 2 to 3%. So fixed deposits is an old mindset. Thanks to, again, the advent of technology, the growth and the learning of the investors, people need to move away because once bank rates go down, the fixed deposit rates have already started going down very rapidly. And bonds take a bit of a time to kind of follow that trend, what we call transmission of rates, right? So traditional FDs are good if you have a short-term horizon, but bonds give you much higher, 2 to 3% higher than FDs and give you all the flexibility to exit, enter, diversify your portfolio.
Okay, that's a wonderful take, and I hope this has given a lot of clarity to our viewers as to why you should be choosing bonds and when you should be choosing bonds over your other debt instruments and why does it make sense. Now help us understand what you talked about, the accessibility part, sir. Help our viewers understand, how easy is it to access, where should one go to access, what kind of bonds are there to choose between from, and is it an easy choice to make at all?
Good question. So first things, I will start with two very important warnings. There is an advent of a lot of online platforms in the country. Do not invest via unregulated platforms. When you invest via regulated platforms like IndiaBonds, we are regulated by SEBI, we are members of NSE and BSE, we are stockbrokers with an OBP license. If anything were to go wrong, you have regulators protection. My second biggest advice or red flag, do not buy unlisted bonds. So bonds are either listed on the exchange like an equity or they are unlisted. Unlisted bonds mean, again, you have no SEBI regulator to protect you. It's a bilateral agreement between yourself and an issuer. So if you've kept unlisted and unregulated aside, then it is very easy. And now I'll come to that. So on a platform like ours, being a regulated stockbroker OBP license, you can actually digitally KYC in 3 minutes and invest in a bond in 2 minutes. And the payment is better because when you make a payment, it goes straight to the clearing exchange. No money touches the stockbroker or the platform, even unlike equities. So the
Okay.
access is a 5 minute access or 7 minute access depending on the platform. On our platform, it's 5 to 6 minutes to actually KYC and invest in a bond. Choosing is important. It should be as per your risk appetite, right? So for people who want to start first time, I would advise buy a government security, Government of India bond, or a triple A rated public sector to get an idea. And obviously, being of higher quality, they offer you interest rates between 6.5, 7.5, 8%, and then move on to something called corporate bonds, single A, double A, which could offer you from 9 to 12%.
Okay.
Again, on a platform, there are various filters. You can choose state guaranteed bonds, public sector. So, Sakshi, over 2 years, we as an industry have learned, right? So
Yeah.
we curate bonds depending on people's choices. We even have a tool called bond case, where if someone doesn't know where to start, you can just construct a portfolio of 5 to 7 bonds for
Okay.
diversification within that universe and make a single payment for all 5 or 7 of them. So that also can be done in 5 minutes. You can just curate an entire bond portfolio on the platform.
Oh, okay. That's an interesting one, a well-diversified portfolio of bonds itself in case you do not want to just select one, which can give you a lot of diversity. At the same time, easy to make a payment of one outgo for all 4 or 5
Absolutely.
bonds that you could actually look at. So that's also interesting. Now, help us understand when it comes to Indian bonds. We've always seen that Indian bond market is not as mature as the foreign bond markets. But are Indian bonds now also gaining popularity among foreign investors?
So I'll humbly disagree with the first point. The Indian bond market in market structure, financial infrastructure, in some aspects is way advanced than the markets I see in other countries. And I've worked in fixed income and bond markets in Europe, in Asia, and things like that. So
Okay.
they're way advanced. It is a $2.7 trillion market already of listed bonds,
Yes.
right?
Yes.
And last year, the biggest, what I call the watershed moment for the bond industry happened was inclusion in global indices, the JP Morgan index, the Bloomberg index, and the FTSE Russell index. This is anticipated to get about 35 to 40 billion dollars of FPI index tracker investment. Just to give you one data point, in financial year 24-25, foreigners invested 1,43,000 crores in bonds, which a number we haven't seen in more than a decade, right? So absolutely gaining popularity because global managers, when they do asset allocation, they have to invest in India because of the tracker. But what other choice you have? If you look at the entire emerging market global complex, people have or would not invest in Russia for the longest time, and China has had its own issues in various market segments. So money is actually pulled out of China. And
Okay.
with headline US China tariffs, I don't know which way it's going. Depends on which side what day news is. People are a little unsure. So by natural selection, India is in force, right? You do not have a large, good democratic English speaking economy growing still at 6.5% projected anywhere in the world. The size of the economy is big enough to get large capital flows. Very popular, very topical globally, and the fund flows actually speak that. So yes, India is gaining a lot of popularity. And jokingly we say if foreigners want to buy, why should we buy our own market, right? So it's a very interesting situation.
Absolutely. Now help us understand what is the current trend that you're looking at between US bond yields and Indian bond yields at this point in time, and what are the macroeconomic factors that are shaping up either?
Yes. So obviously the US rate cutting cycle or rate hiking cycle in 23 was much higher because we stopped at 6.5%. And then the rate cutting cycle also was a little ahead of us. We stayed paused and then we cut. So I think as mentioned with a so-called technical recession in the last quarter in the US at minus 0.3% of GDP and CPI numbers slightly high but still being in control, And importantly, the fears of these tariffs, and again, the outcome is not known, would cause natural stress, right? So I would anticipate the next move that the U.S. Fed does is cutting rates. There is a meeting on 8th May next week actually, which is quite a pivotal moment because it depends on the tone the Fed is going to take, right? So one thing is for sure, Fed independence has been kind of put in place. I think India already moved, cutting 50 basis points. The next move would depend on our domestic growth factors and global factors. But the direction remains downwards, I think, which is a comforting factor for bond investors.
Okay. And looking at this divergence, how are you looking at capital, inflows now into the emerging markets when it comes to bonds?
So there is a trend or chatter till December we were all about US ranks above everything else in the world, and now there's a chatter, let's run away from the US and allocate to other parts of the world. So I think if the capital flows on a macro basis are moving away from the US, then as alluded to, the emerging market flows naturally would come to India as compared to Russia or China, which are the larger economies. Of course, the April data is too new a data, and there's still minor outflows because of global volatility. But I'm very, very bullish that 25 billion of additional flows from bonds from foreign investors will continue to come into the country.
Okay. Last two questions that I have for you, sir. One is that are there any risk factors also that one should keep in mind when one invests in bonds?
No, absolutely. So again, I would like to highlight different bonds have different returns. You should pay attention to credit ratings, which will tell you a AAA is supposed to be the safest, and there's AA and single A. And you should see what your risk appetite is. You should study on the industry. It's your money, so you should be reading about the rating reports of the company or the information memorandum. No investments are really risk-free in life. Technically, government bonds are supposed to be risk-free, and they are also alluded in classic finance. The government bond is risk-free, but bonds do have certain risks, right? So, namely liquidity risk. If you were to buy a really high-yield bond at, let's say, 12 to 14%, there's a reason it gives you 12 to 14%. That probably if you want to exit, it might take some time to exit.
Yes.
And I'm talking about a few days or a week or two. Government securities, you can trade in and out any day, like, or any minute that you want to. So liquidity risk is something to watch for. Obviously, it's a company, so like equity, fraud risk also remains, right? So we have had stories where companies have had fraud, and that is something.
Yes.
The only way to mitigate that is to diversify your portfolio. So instead of just buying one high-yield bond, break your investment into 3 high-yield bonds so you mitigate that risk. Third is the market risk, right? Which means if we have a big exogenous, market shock, then it could be, your investments can be hampered, right? Market risk also is about interest rates if they move in the country. But as I said, right now the trajectory is lower, so possibly you don't have a shock from market risk as such. So keep this in mind. Again, you have to do your work. It's your money. Do not rely on others. Spend that 5 minutes on a platform like ours. We have information on the company. We have rating reports. Everything is accessible there. You don't have to go anywhere to access that information.
Okay. And the last question is, you did say that, we are now as big as 2.7 trillion as far as the bond market in the listed world is concerned. What is the kind of outlook that you have over the next, say, 4 to 5 years odd? What is the kind of expansion that you expect in bond market?
So I will give you an example that the developed markets of US and Europe or Japan, the bond market is 125 to 200% of the equity market cap. Because these markets are large and developed, capital or credit creation comes from aware large institutions and retail. In India, it's not so. The bond market is only 65% of the equity market capitalization. So theoretically, as we become more developed and our journey towards Viksit Bharat and Atmanirbhar Bharat, I would imagine the bond market to grow or more than probably double in about 5 years time. We have seen the corporate bond market is actually accelerating at a faster pace this year than the government security market. So very, very bullish on the growth of the market. It's not just a view because this is the business, but that's macroeconomics, right? Classic growth of countries. If you become a $7-8 trillion economy, the bond market will have to take a large share of that capital.
21 minutes of a discussion that we've had with you, Mr. Goenka, and it almost seems like a masterclass on bonds that we've got all our viewers through. Thank you so much. It's been an absolute pleasure speaking to you and seeking all those insights, and we should definitely do this one more time to help all our viewers understand a little bit more once they have warmed up to how does one really look at bonds, whether this also is a core part of the portfolio, and one has to have bonds, like you've said, that everybody should definitely look at bonds, at least allocate some amount of their core portfolio into the bond market as well, and looking at what the trends may shape up. This is something that all the Indian retail investors must definitely look at. Thank you so much. Appreciate your time with us on Business Today Television, and we'll continue to get you back on board to help all our viewers understand more about bonds.
Thank you, Sakshi, for the opportunity. Fixed income and a bond in every hand. That's important for the investor.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.